So I want to do a video about why I think the millennials are not calculating everything they should be and why they keep renting versus they're buying. And I think this is something that a lot of people will find valuable. So anyway, your income disbursement works like this. You make 100% of your money. You can use 41% toward your any of your debts, whether you rent or you own. You'll have 51 left over. You'll pay 28% in taxes. You'll then have 31 left over. The goal would be 10% in savings and 21 left towards spending on your life, eating out or whatever you're going to do. So with this being said, the first thing people have to do is they have to start getting a savings. You have to live below our means. The lower the number, the better. And then ultimately, other people have other things they use 21% for, which could be tithing or something else, but this just means they live lower, but you can't forego the savings. And here's why. What you're going to do with this savings is, assuming you made $30,000 a year, then you would then save 10%, you would save $3,000 over the course of the year. And so you can calculate all of that and do your payments each week, putting in the savings account. But the goal of this 10% is not just to save it for a rainy day. People don't have budgets, but they should budget for all the rainy day items like a flat tire or the car breaking down or medical things or different things like that. You need to be saving for that, which should be in your 21%, not the use of your 10%. Okay, so the reason we're going to have this 10% is it's going to give you your $3,000 each year. So we're going to put that right here. Then what's going to happen is we're going to take that $3,000, but that's not to go save. That goal of that is if you take that maybe 2 years, let's say we just saved for 2 years, and now you've got $6K. Then you're going to bring that back to your 100%. How do you bring back the $6K to 100%? I'm going to tell you the first thing you should do, if you don't have any other stocks or anything else that you're doing, this should be buying a house. And here's why I'm going to break that down. So you take this $6K, you're going to take $5,000 of it. We're going to keep $1,000 as emergency fund. We're going to bring this $5,000 over. We're going to put it down on a $105,000 house. Now, obviously, these numbers will change depending on what you're buying. I'm not a CPA. I just want to give you the general overview of how it all plays out. So you put $5,000 down. You buy a $105,000 home. You're going to finance now at 4% the $100,000. It's going to give you a payment of $477 principal and interest. This is not counting taxes and insurance, just to keep it simple. Of that payment, it's broken down to $333, which gives you $39.96 a year in interest payments. Then you're going to pay $144 of it toward principal, so you're going to have $1728. So if you did nothing else, you're going to have $1728 every year going toward your value of your home or adding your equity. Now, ultimately, this number tends to go down. So the first payment would be $333. The next payment, the interest would be $332, and while the principal was $144, the second payment would then be $145. So they change in the interval, so which means this number goes up and that number goes down over the course of a period of time. We just want to make sure you understand that. The next thing is you take the property value of 100. I did 100,000, and you take that depreciation over 27.5 years. So which means when you buy a house, you end up having a house where you bought it one time, $5,000 down, but you end up with $3,600 tax saving over the next 27.5 years. Now, keep in mind, if you sell this home, you'll have to then give taxes back on this, but I'm going to show you how this plays out in a minute. So each year, you're ending up with a net, a positive from your $5,000 down to $1,728. That makes perfect sense, right? In 30 years from now, after making this installment, you're going to own a home free and clear. But it gets better. You take this number, the $39.96 and the $36.36, which is your depreciation and your interest each year, and it's going to come down to $76.32. Now, what that is going to matter is not that you're going to save $7,632 each year. It's going to play out like this. Remember how we went over our taxes over here of 28%? That varies for everybody, so it's gonna change. But so you'll have $30,000. If you pay 28% in taxes, you're paying $8,400 in taxes. Okay. If you take the house purchase of the $76.32 depreciation and interest write-off, you get to lower your income to $22,368. You still made $30,000 from your job, but you're gonna have $22,368. And when you lower your taxable income, for the way the IRS sees it, you also lower your percentage of how much you pay on taxes. So what happens is you end up, instead of paying $8,400, you pay $5,592, which is a $2,808, I think I did that math right, savings every year. So now every year, varying a little bit of interest changes that'll change, you'll be able to take $2,800 back that you would have paid to the government otherwise from a $5,000 installment plus your $1,728 of tax write-off. So anyway, this is just something that everybody should consider when they're looking to buy a house. Obviously, we do free home buyer consults. You can go to finchteam.com and find out more about us and set up a consultation. This is just one thing. I'll put out more videos. There's a lot more to learn, but this is just one thing to consider. Thanks.